Greetings, everybody. Welcome to Liberty Call. Today is Thursday, September 28th, 2023. Hope everybody's having a fantastical day out there in the interwebs. You can see my head security guy back here, Jake, snoozing on the job. He wants to go out and play some ball in a little bit, and then dinner time is after that. So that's kind of his his day. So anyways, like I said, glad you're here. Hope you're having a fantastic day. Looks like the markets are in a much better mood. We got happy little markets everywhere, as opposed to those angry markets we had on, what was that, Monday, Tuesday, even a little yesterday. So anyways, well, if it is your first time watching a Liberty Call, I am glad you're here. We're going to talk about how the markets turned out today. We're going to go through the market recap. GDP has been revised down. Ooh, not good. Not just for like a couple of quarters, 3 years. And then we got the dangerous myth of a soft landing article from Mises. So let's go ahead. And if it is your first time watching Liberty Call, again, like I said, I'm glad you're here. If you could do me a favor, you right there in the orange shirt, give him some thumbs up. Likes, share, subscribes, follows, press that notification bell. Now let's go ahead and get into the numbers for today. All right, Dow Jones was up 0.35%, 116 points, closed at 33,666. Oh no, that's the Satan number. S&P 500 up 0.57%, closed at 4298. NASDAQ up 0.83. So tech seemed to be the best of the major indexes here. It was up 0.83%, closed at 13,201. The VIX down 4.83%. It's at 1734 right now. Canada was up 0.8, Brazil up 1.19%, and Mexico up 0.21. Our buddies over in Europe, Germany up 0.7%, the UK up 0.11, France up 0.63, Netherlands up 0.59, Spain up 1.02%, Italy up 0.54, Switzerland up a third, and Portugal down 0.26, kind of a weird outlier. Russian exchanges, both green today. MOEX up 1.32, the RTSI up 1.18, and the overnight's not quite as happy as here in America. The Nikkei in Japan was down 1.48%, Australia flat, down 0.08%, New Zealand down 1.09%. In China, the Shanghai was up 0.1%, the Shenzhen component up 0.05, so basically flat. China A50 down 0.58, DJ Shanghai up 0.06, Hang Seng down 1.15%, and the Taiwan weighted was up 0.21% for today. All right, so like I said, it seemed like the later in the trading day, starting with Asia, last night and then going through all the way through today, it seemed to get better and better and better. So again, not that that means anything long term. I think things are still a mess, but anyways. All right, let's get to the market recap. S&P 500 rides tech higher as yields pause, rally ahead of Powell and inflation data. The S&P 500 experienced a rebound led by major tech stocks such as Alphabet, Meta Platforms, as Treasury yields took a pause after recent highs. Investors awaited a speech from Federal Reserve Chair Jerome Powell, speculating on whether he would alter the hawkish stance from the previous week. Powell's speech preceded key inflation data expected to reveal steady core inflation for the previous month and a continued slowdown in the 12 months through August. Chip stocks contributed to the market's upward movement, particularly due to a rally in AMD, offsetting a decline in Micron Technology. Micron stock fell over 4% after forecasting larger losses for the fiscal quarter. Despite better than expected quarterly results, analysts expressed support for Micron, believing the supply glut in the memory chip market is easing. CarMax faced challenges, with its stock dropping over 10% after reporting second quarter earnings below Wall Street estimates. The company attributed this performance to ongoing issues with vehicle affordability amid inflationary pressures, higher interest rates, and tightening lending standards. In the realm of partnerships, Peloton Interactive and Lululemon joined forces. So I guess that's kind of like the wine moms, the the people who wear those yoga pants and pretend to work out on their Pelotons. Peloton aims to simplify its business by outsourcing its apparel business to Lululemon, which will become its primary athletic apparel partner. The collaboration will also allow Peloton to expand its content library, granting access to Lululemon's studio members. This move aligns with Peloton's strategy to enhance its business model. As markets continue to react to economic indicators, corporate earnings, and central bank communications, investors navigate a landscape influenced by factors ranging from inflation concerns to supply chain disruptions. So that's the news for today. All right, let's get to some little deep diver here. U.S. GDP revised down in every first quarter from 2020 to 2022. So that is not good news. All right. Revised government data from the Bureau of Economic Analysis, the BEA, revealed that U.S. economic activity in the first quarters of 2020, 21, and 2022 was weaker than previously estimated, primarily due to downgrades in consumer spending. However, the BEA stated there was no evidence of residual seasonality affecting the GDP data, a problem that was addressed in 2018. For the first quarter of 2020, GDP was revised down to a contraction of 5.3% annualized rate compared to the previously reported 4.6. However, the GDP for the entire year of 2020 was upgraded by 0.6 percentage points to show a contraction of 2.2%, reflecting strong performances in the third and fourth quarters. In the first quarter of 21, GDP growth was revised lower to a rate of 5.2%, down from the previously reported 6.3%, with consumer spending also revised downward. The full year growth for 21 was also trimmed to 5.8% from 5.9%, reflecting downgrades to government spending and non-residential fixed investment. In 22, GDP contracted at a rate of 2%, rate in the first quarter, revised down from the previously reported 1.6%, primarily due to flat consumer spending instead of the earlier reported 1.3% growth rate. The full year economic growth for 22 was lowered by 0.2 percentage points to 1.9%, with downward revisions to various components, including consumer spending and government spending. The annual benchmark revisions incorporated results from the 2017 economic census, and while the referenced year shifted to 2017 from 2012, the economic picture remained little changed from 2017 to 2022. The COVID-19 pandemic recession was noted as the deepest on record, with the economy contracting at an average rate of 17.5% from the fourth quarter of 2019 to the second quarter of 2020, revised up by 0.7 percentage points. The recovery that followed was the second fastest in history. Well, when you print $5 trillion, I mean, who would have thought? In terms of inflation, the data showed a slight upward revision for 22, with the personal consumption expenditures price index, excluding food and energy, increasing by 5.2%, up from the previously reported 5% even. The core PCE price index was also revised higher in several quarters of 2022. All right, so looks like they've gone back and redone all the numbers, and it's not quite as good as they said it was, but anyways. All right, last up, it's an article from Mises Wire titled "The Dangerous Myth of a, quote, Soft Landing," written by Daniel Lacal. So let's get to my notes here. All right. Mr. Lacal raises concerns about the current optimism regarding the U.S. economy, drawing parallels to the sentiment in 2007 before the financial crisis. I remember that was a fresh new advisor back then. It's not a good time. The argument against fears of recession is often centered around the belief that the Federal Reserve can inject liquidity as needed through quantitative easing. That's money printing, buying up toxic assets off the market. However, the author contends that if monetary easing is seen as the sole antidote to prevent a crisis, it increases the risk of stagflation. The private sector is described as being in the midst of a recession, hidden by extensive government spending. The latest Purchasing Managers Index readings support this claim, indicating a decline in service sector momentum and manufacturing production. The U.S. consumer confidence has also seen a decline in August. The author expresses further concern about the reliance on debt to sustain the services sector and consumption. Despite elevated inflation, the U.S. government continues to increase spending, leading to rising debt levels. The personal savings rate is noted to be below pre-pandemic average, and total credit card debt has surpassed $1 trillion for the first time, contributing to record household debt of $17 trillion. That's a lot. The rising debt is portrayed as keeping GDP afloat while inflation expectations remain high. Mr. Lacal highlights the dangers of a large government deficit exceeding 9% of GDP and emphasizes that rising debt could lead to higher taxes, inflation, or future government debt. The conclusion calls for action, suggesting that the government should cut unnecessary spending, which is basically all of it, and reduce the deficit, while the Federal Reserve should tighten its balance sheet. The author argues against further government stimulus plans, stating that monetary contraction should focus on reducing public sector imbalances rather than adversely affecting the private sector. The warning signs are underscored, and ignoring them is deemed irresponsible. I agree. It is irresponsible to allow this debt to just pile up and pile up and pile up, and the inflation and everything else that goes along with it. And, those in charge don't care. And most of the people who vote have no clue, and they just hope their team wins. So that's why I am hoping for the fall of the U.S. government. Hope it collapses. I'd like to see D.C. razed to the ground, and let the rest of us, we have 50 independent nations or states, and we can just live our lives peacefully. I mean, and also the rest of the world would probably be a lot happier because they wouldn't get drone bombed just because they have oil under their ground. So anyways, all right, I'm off my soapbox for now. All right, well, I hope everyone has a wonderful evening. I will talk to you guys next time, and talk to you later. Adios.